I want to welcome everybody to a very special edition of ATLalts. This is your host, Andre Sandate. I am recording this here in Atlanta, and I am joined today by somebody who there is a deep backstory to get into, but I want to welcome and allow him to give his backstory. Sreeni Prabhu. He goes by Sreeni. He is the co-founder, managing partner, co-CEO, and group CIO at Angel Oak Capital, which is nearly a $20 billion asset manager, but really a big giant company in Atlanta. And he leads the overall investment strategy of the firm. He also is he's also the CEO and president of Angel Oak Mortgage REIT, which is a New York Stock Exchange company. Ticker is AOMR. You can learn more about Angel Oak at angeloakcapital.com. There's a lot of great resources, some terrific content, educational resources. If you're an advisor that's already doing business with Angel Oak, you can see the territory map and the coverage map. If you're an investor or family office and want to engage with the institutional team, Adam Beeler and a number of other guys over there are terrific. So lots of really great resources. That's a long introduction, Sreeni, but I want to welcome you to ATLalts. I'm excited to have one of our local terrific firms that's just got a great reputation to ATLalts. This is the first time we've had you on, and the first time we've had a chance to allow Angel Oak Capital to tell its story. So with that, sorry for the long-winded introduction, but welcome to ATLalts.
Thank you, Andres. I appreciate it. I really appreciate you having me on the podcast.
Yeah. So first question is always, the same, and that's tell us your backstory. How did you arrive at, that long, terrific title that oversees $20 billion, lots of strategies, lots of products? Tell us the backstory.
Thank you. It was a different way to get here. First part of my life, I grew up in India. Played tennis growing up in India, and had an opportunity to come to the US to play college tennis. So I had a little bit of a different path to come to the US, and found a small school outside of Atlanta. Did my undergraduate over there, and was able to do my master's at Georgia State. And tennis has played a big role in where I am today.
Yeah.
Even my first internship that I got at SunTrust Bank, we were both familiar with it.
We're both alums. Yep.
Yeah. I got my internship because the person who gave me the internship was also a tennis player. And he, I didn't know much about finance. I wanted to do it. That was my few of the classes I took at Georgia State University. And I just happened to fall into a great seat with a great boss who actually, as a part of our firm development, he now works with us at Angel Oak Capital. And he runs the financial strategy. So, as having a good seat in the early stages of your career is big, and SunTrust you have that. Quickly migrated, and I loved the whole background of asset-backed structures, asset-backed securities, but basically asset-backed finance.
Yeah.
And how in the US, little differently than the rest of the world, how financing plays a huge role in every single thing that we do daily, right?
Yep. Everything
we do.
Buying a car, getting a house, taking out a loan on your house. It's everything.
It's everything. And so I was in the early stages when there were not many players involved. I learned a lot, and then went and became a portfolio manager. Then I had an opportunity to go to Washington Mutual, as you know, the center of the crisis,
out in Seattle.
Yeah, I was the head portfolio manager of the Treasury bond portfolio, not the bank.
Yep.
And by 2007, I'd seen the writing on the wall, and I knew that these assets would have to leave the banking system. I can't tell you that I predicted the Armageddon that fall, but I clearly didn't.
But you became bearish, and I want to stop there. There's some things we're going to circle back to on your background. We have an audience of advisors, family offices, institutions, but we also have an audience that we target of folks that want to break into the industry, people that are in the industry but want to one day run their own fund. They want to build their own company. They want to get on the buy side, if you will. So we're going to circle back to some stuff, and I don't want to cut you off, but there's a headline from Barron's. I would be remiss if I didn't bring this up, and you can find this out there on Google. I didn't even download the whole article, but it's effectively a profile written in 2017. Your firm, Angel Oak Capital, we're going to talk about what you all do in the non-QM, non-qualified mortgage space, particularly in the, residential mortgages. But the article says, and again, this is Barron's, in 06, you were running $25 billion bond portfolio at Washington Mutual, as you said. Yeah. When, again, this is the author, when lax lending, iffy appraisals, and general sentiment in housing was, housing prices are going to continue to go up. And you turned more bearish. Yeah. And even despite the fact that other divisions within Washington Mutual were churning out loans to arguably, at the time, it's easier to look back, some of those more iffy borrowers. And obviously we all know, those of us that were in the market or participated in the space know what happened in 07, and certainly the broader economy, what we saw transpire in 07, 08. You were in the middle of it. Yeah. So again, I cut you off, but this is unique that we have somebody that, you fast forward now from 07, 08 all the way to today with that backstory, growing up, looking at it at SunTrust as a bank analyst. I mean, you've seen the entire value chain.
Yeah. No, it's and I wanted to finish that. It's that's when we started Angel Oak Capital in 2008. I left Washington Mutual.
Okay.
And to answer your point on being bearish, a few things, right? Look, as you said, a lot of people were not trying to do wrong things. It was where you were in a life cycle, and I think what happened before the financial crisis was there was a big fight in almost all banks between business and credit, right? Mm-hmm. And when there was so much fees and so much commissions and so much profits that were generated, it is very hard to stop a train that is going at full speed, right? And the whole infrastructure built around it. I think that we, as a general fixed income community and as a general Wall Street community, just lost the plot, right? Yeah. And that is not reserved for Washington.
And there were other forces, right? Comment. We want to get into the micro as well, and we could talk macro, but I'll leave that to the Bloomberg articles and the Bloomberg conversations. But you also had regulatory stakeholders that were sort of promoting, getting, making credit more available. The government at the time, they were promoting credit, getting that first home. I mean, there was a lot of moving parts, a lot of influence, quality of earnings, and earnings on Wall Street, that whole machine. I mean, it's easy to look back and say this wasn't going to end well.
Yeah. Yeah.
But it was a moving train.
Yeah, it was a fast moving train. It was, and we'll keep it macro, and it was a combination of late 90s where banks realized that they could be efficient at managing their capital by originating any type of loan, consumer, mortgage, auto, credit cards, and then using the securitization markets, and then delivering it to a variety of set of investors with different risk tolerances, right? To a basic premise, that's what it was. If you want safety, you bought the most senior bond. If you wanted risk, you bought the most junior bond. And these assets then pervaded through the entire financial system. So that was one thing that happened and allowed banks to create more lending, which probably created more growth in the economy. So that's a positive. And we see the fruits of it now as the sector has flourished over the last 15, 20 years. Then there was a government program to create housing more affordable, which allowed lower mortgage rates, and that with the financing available just created this own little velocity. And then the third part was, the concept that these mortgages and the way they were rated, and the ratings created its own leverage in the system. Yep. You put all that together. The base fundamentals of what was being done was not wrong. It was the addition and the subtractions that happened afterwards. And I would say from 2005 onwards, that created what we had in 2008, which was the financial crisis.
Right. We call it addition subtraction here on ATLalts because I want to keep it simple with all due respect. Yeah. A lot of people would call it engineering. They'd call it securitization. I mean, a lot of these things, but effectively, yes, what you're saying is we productized a 30-year mortgage. Yes. Whether it was or we productized a non-qualifying mortgage. We'll break that down and get into that. All of that is really important backstory for
Yeah.
what we're going to get into. But I want to circle back more on the professional front. You talked about coming from Mumbai to play tennis. For those of the listeners that are in Atlanta and familiar with the South, they're going to know the community of Milledgeville.
Yeah.
But for those that are, not, Milledgeville from Mumbai, describe that experience. And
I
this is
will.
this is also something I wanted to cover because those younger professionals, those people that are thinking, I want to work at a hedge fund one day, I want to work in alternatives, I want to work in private equity, and they're not, with all due respect, they're not at a target school.
Yeah.
They're grinding away, getting a business degree, finance degree. Maybe they're starting a junior college. You are now, co-CEO of a $20 billion asset management company.
Yeah.
And you started out, and I looked this up just because I thought it was interesting. U.S. News and World Report, you know what they ranked your undergraduate alma mater? Regionally in the South, the 16th ranked school.
Yeah.
So I don't say that to put you on the spot. I say that because I think there's a really powerful story in where you're at today. And I think we'd be remiss if we didn't allow you to talk more about that experience, getting there, what you did when you got there, the tennis, and maybe there's a nugget or two.
Yeah. No, I appreciate it. And look, it's hard, right? As you know, it's hard. But the first thing I would, it's funny now saying that. If you can remember, when I was applying to schools, that it was not like you had a variety of computers sitting there. I had to go to this U.S. Embassy, which had a small library. You had like a couple of, but you were really opening up. I think it was the Peterson's Guide of Schools, and you opened it up and you started randomly. And I believe that the way they talked about Georgia College was that Milledgeville was a suburb of Atlanta. And I can tell you, folks, it is not a suburb of Atlanta. It's more a suburb of
Right.
it looks like.
Yeah.
So that was the first shock I had. I walked in there, and I think I went from 15 million people to 15,000 people.
Wow.
So it was a culture shock.
Yeah.
My first breakfast was eggs and grits. I'd never had grits before, but I loved it, by the way.
Yeah.
But I would tell you, the community was phenomenal. I mean, I never felt uncomfortable. I just enjoyed my experience. I was on a tennis team. I had a great team from different parts of the world. I had to room with American students for first 2 years because of my scholarship. So that was great. I got to sort of see people that I just would never have seen if I had grown up in India.
Yeah.
But getting back to your school, I mean, look, we can all think about going to the top schools in the country, and there's a value proposition to that. There's no doubt. You create your networks, you create your, and that's the hardest thing for if I have to tell somebody is, for you and me and others, like the networking was just absent, right? When you come out of smaller schools, you just don't have that network.
That's right.
But I think I tell that to all the guys here in the office and others. Like, look, we've learned to. You just learn to fight. You just learn to compete with a very positive attitude.
Yeah.
And you have to think about long-term business. And I think if you work on Wall Street, sometimes your thought process is more short-term. So when you don't work there for some time, and nothing wrong in that, but it just happens to be. Where if you've not worked there, our process is more long-term, more relationship. But you have to compete. I mean, these are a lot of smart people in our business. So. Small schools, regional schools, yes, you are starting behind, but I would tell everybody that does not mean that you can catch up much faster than people give themselves credit.
Yeah,
in my mind, and you just have to stay played.
You got to know what you got to know what you don't know, and you got to kind of have that North Star. And like you said, you found yourself, you matriculated at SunTrust as a bank analyst. You're covering banks, and you had what is now a colleague as that terrific boss. I'm thinking, you move up to the big city, you start that job, and all of a sudden you become more fascinated, it sounds like, on this whole world of asset-backed finance and mortgages and banks, etc. And then you're kind of off. And it's so easy for us today look and say, let's just spend a minute on that, and then let's get to talking about XYZ.
Yeah.
However, if you go and watch the video that you and Mike are featured on Angel Oak, I wrote this down.
Yeah.
You have built a company.
Yeah.
You want to have relationships with borrowers. You want to have relationships with investors. You're an alternative fixed income manager generating an income or building an income solution for retail and institutional investors.
That's correct.
Now, I am sure that took some time to get to that what we are. And that's what I want to transition to, because you spend time as a bank analyst at SunTrust. Then you said you moved out west to Seattle. You're at Washington Mutual. You're now more specialized. You're running a $25 billion portfolio. You see what's going on in the housing market. Talk to us about how you and your co-founders, and now Mike, your co-founder, co-CEO, how did you guys meet?
Yeah.
How did you pull this together at an awful time broadly in the economy and in the market to want to go start a company?
Yeah.
Unless you know where the bad paper sits, perhaps.
Yeah, so we knew all that. We knew where the paper was. I had never started a business. To be fair, Mike Fearman, my partner, has always been an entrepreneur. So again, that's important here, because when you partner up with somebody, you need to have some sort of an entrepreneurship, and to be honest with you, some sort of a utopian view on the world, right? Day to day is a grind. We got introduced by a common friend. I wanted to come back to Atlanta. I didn't know anything about Atlanta, to be honest with you, in terms of people over here. We thought we had this wrong idea that we could just start a firm, create a presentation, and raise institutional capital. We were clearly wrong in our thought process. But before that, when we met, we probably met for 2-3 hours, and it was never about we just clicked on starting a business. I know we knew we would buy bonds, and we knew we had to go raise the capital. We started. It was just a part of, hey, do you want to do this long term, knowing that you're not going to see a return on your investment for years, right? A couple of years at least. I mean, you're putting your own money in it. Interesting enough, I was also talking to a few folks from New York, and their common theme was you cannot launch a fund without having at least $100 million of capital. Well, my point was how are we going to get $100 million of capital? Well, the only way you can do it is institutions. We probably, we started the firm, we put our first presentation together. I told my wife, I'm going to leave WAMU, and, I'm going to take this risk. She was, without her, this would not have started, right? She's like, all right, let's go take the risk. She came back to Atlanta. But, first 3 months was brutal because we had no institutional backing. The world was changing by the minute at that point. But then it gets back to us, right? We thought that the 100 million was a wrong way to go, right? We could do this all day long and run out of time and effort and money. So we went to say the next option and said, just raise singles and doubles and talk to people here in Atlanta. So we would sit at a breakfast place here in Atlanta called Goldberg's. And
right.
We would do 15 to 20 meetings a day. We would wave to people.
Yeah.
Half of them thought we were crazy. Majority thought we were crazy.
Yeah.
But we had a group of guys that gave us our first $10 million. So that's how Angel got started. It was a $10 million fund in June of 2008, I believe, to buy distressed mortgage-backed securities. And the one thing we did for investors is, even though it was a hedge fund, we would distribute cash flows on a monthly basis.
Right.
So they got to see that, hey, there's a mark-to-market element, but hey, I'm getting my cash flow.
Yeah.
Right. And they would come to our office. We would show them the bonds you're buying, and they would really look at it and say, oh, okay, how many people will need to default for you to lose your money? Then they told their friends, and they told more friends. And by 2011, I'm a little forward. It's a pivotal point for us. But 2011, we probably had 200 plus high net worth individuals in variety of our funds. We probably managed about $200 million. So our background, and by the way, those individuals are still with us in some fashion.
Exactly, they are. I used to work for one of those individuals, Andy Cummings. I'm going to give him a shout out. It's been a long time since he and I have caught up, but I say that because Mike Fearman, as you said, entrepreneur, he's a co-founder of South Star Funding. They're doing, at peak, like $6 billion a year of this origination of non-QM mortgages. They're moving the paper. There's a process, a machine working. They're selling it to the bigger firms, the bigger banks, some of which aren't around today. No. But that's working. So there's an important lesson in what you said, finding complementary strengths,
Yes.
thinking long-term from the outset, and you said this 10 minutes ago, grinding.
Yeah. Yeah. You got it right.
You're not coming from these pedigreed institutions, right? So for all those managers that are listening that want to go build a business, whether it's in real estate, credit, private equity, venture, the first 3 years, you're going to be anonymous. I think is an important message that I heard. And you got to just do what you got to do within the bounds of what's allowed. Go to sit at a restaurant, go do the high net worth channel. Talk about the next phase after 11. But before I do that, we talked about this offline. I had a meeting with Mike and David Wells, your chief portfolio strategist, who was the managing director at the time.
Yeah.
We got introduced. I had a former business partner. I had just left banking myself. I think this was the third or fourth asset manager I met. And I was at SunTrust and Capital Markets, one of the divisions that was growing while I was still there. Looking back, it was not the right time to be growing, was the securitizations business. They were getting into all this stuff that Wall Street was winding up.
Yeah.
And that's kind of the story for another day, but regional banks just being sort of behind, both in innovation, but also in unwinding, the book when it needs to be unwound. And I remember leaving that meeting with Mike and David thinking, I don't know what in the hell these guys are doing, but they're super wicked smart.
Yeah.
And it's a lesson that I'll never forget in just because you don't understand it on the surface right away, don't allow an opportunity for the advisors listening, for your client to miss out on something. To your point, imagine being one of those early investors, staying with the business, staying with the strategy over what is now 15 years.
Yeah.
The kind of capital you created. I know some of those people had an opportunity to invest in your business and probably wish they had. And some probably did. But I think that's an important lesson for advisors as an aside before you get into sort of that inflection point in 11, which is there's a lot of stuff out there that's on the surface. People just say it's too hard. I don't understand it. And they just move on. But I kick myself still to this day. I don't have regrets. I'm still glad we're connected and friends. But I look back on that conversation and say, shit, I wish I would have, spent more time digging in. Woulda, shoulda, coulda. But it's an important lesson for advisors. I think we are fiduciaries. Our obligation is to do the research and find the right strategies. And sometimes that means, doing the extra work, asking more questions. Don't just pass on it outright. So let's get back to 2011, the inflection point. You're at 200 investors. You're growing. It's still a private fund business at the time.
It's still a private fund, and it's actually a series of funds. So we had probably 3 or 4 funds, maybe. So we're creating just a series of funds, getting just a little bit more, differentiated in each strategy. So 2011, if you remember, that's when Europe was struggling, and we thought we were coming out of doldrums, and we went right back in it. 2011 was not the best year, but the distressed opportunity in mortgages had kind of disappeared by then, right? Because Fed had come in, liquefied the system. Government had come up with public-private partnerships to buy these assets. So the concept of distressed mortgage-backed securities became more opportunistic. Okay, so in hedge funds, if you think about it, at that time, when we were buying these distressed mortgages, you could buy, not even put leverage, and make 20+% IRRs. That opportunity changed in 2011, where now you have to do 2 things. You have to go more down in credit, or you have to apply leverage. So you're going back to what the hedge fund model was. And we had told our investors that we generally would not apply leverage. We had just been with these guys. And so we knew our returns would be down, but we would still give cash flows to our investors. So we had a choice to make. We could either just hold the funds, take our profit, return money back, or build a business around it, right? Because just managing a hedge fund at that time was just, at that point, you were just going to amplify more and more leverage. So we actually said we don't want to raise that much more money in the hedge fund structures. How do we deliver this value to all sets of investors, retail and institutional, right? So, and then at the same time, we were also saying, legacy mortgages are disappearing by the minute, and nobody's originating new mortgages.
Right.
And why is that? So there were two things that were happening, and it was just 3, 4 of us in a room. You came to see us at that time.
Yeah, 50 Old Ivy next to house.
Yeah, Old
I
Ivy.
mean, it's incredible.
And you know, we we had to make a decision again to put our money back on the line, right?
Yeah.
So we had put money in the beginning. You know, we were cash flowing as me and Mike, and then we were like, okay, we want to build a business. We want to build a long-term business. How do you do that?
Yeah.
Well, you got to hire good people. They'll come work with you and work for this dream and idea that you're putting together. So we started putting three things we did. We started putting teams together to do all sorts of asset-backed securities. So whether it's CLOs, CMBS, ABS, and obviously we were doing mortgages. Till 2011, all we were doing were mortgages. So we put a team together. Then the next idea was, okay, we are investing in structures that nobody really knows. These were toxic mortgages. Nobody wanted them. How do we deliver them to the retail side? Who's going to trust us? And we had one local investment advisor that said, I know what you're doing, but my clients cannot be in a hedge fund structure. Can you deliver that in a mutual fund structure? And we said, look, we can do that, but it has to be more liquid. It is not going to achieve the returns that you want, but it's going to be a good relative value versus high yield and high grade.
Right.
It has to be a smaller fund. It cannot be $100 billion fund. Not that we were even close to that, but it has to be a smaller structure. And that RI gave us money. This is a true story. And another advisor from California, I don't want to mention the name, they cold called us. They had screened us for 4 months. And they said, we really like your strategy. We have been looking to invest in non-agencies. Everybody in the mutual fund community was investing at that point, but only sleeves of it. Nobody had a big allocation to it.
Sure.
We like what you're doing. And I think they gave us $100 million. And I've never been like, that was the first big.
You're like, yes.
Yeah.
We've got something here, folks.
So, again, people taking faith in what we're doing. We didn't even know this group. We still look back and we feel that this was the most important group for us in what they did for our firm.
Right.
And then we got onboarded on wirehouse platforms, right, which is very difficult to do, as you know.
Oh yeah.
And again, we just screened well. People liked what we had to say, and even today, when you go to this, okay, there are years when we will underperform, there are years when we'll outperform, but we do what we tell you we are doing, right? We we didn't scope creep, we didn't go crazy in other things. Even when when you think about subprime mortgages, a lot of our funds didn't own a lot of subprime mortgages. Yeah. So we committed to what we wanted to do. So that was the one thing, is to put a team to really say that we can't just say that asset-backed securities are the best. We have to look at it across the board in terms of fixed income. So like today, we have a high-yield corporate bond portfolio manager. We have a CLO portfolio manager. So we look across fixed income credit. But at the end of the day, we are asset-backed, mortgage-backed securities franchise, but we look at it.
Yeah, you do.
The second thing we did, which really started in 2011 but took off in 2013, is we launched a mortgage company.
Yep.
To do the new non-agency, or what is called non-QM mortgages.
Explain what that means real quick. I know that folks will want to understand that non-QM mortgage agency, non-agency. Help people understand that.
So after the financial crisis, the government wanted to really come and define like why this fraud or poor underwriting happened.
Why did we have this big bubble?
This big bubble.
Yeah.
Everybody was getting mortgages, and they created these names. But at the end of the day, how do we contain it next time around? So they came up with a few things. They said, if you're a W-2 income, if you're under the threshold of government mortgage cap, if you have 2 years of whatever earnings, then you're a qualified mortgage, right? It's a checkbox. It's called delegated underwriting. You go in and it's a government mortgage. Banks can do it, and you're qualified now.
That's right. And so people have heard of Fannie and Freddie, these big sort of quasi-government agencies. They will, if it's QM mortgages, they will support the banks that originate that mortgage, or the wholesale mortgage companies that originate on behalf of the banks. How do those entities, just again, education a little bit, how do those agencies fit into the QM market?
So they are the QM market, right? So Fannie Mae and Freddie Mac are the qualified mortgages. So when you buy a total return bond fund, and they say agency mortgage-backed securities. That's all qualified mortgages, basically.
And
Right?
so those banks, those lenders feel safer lending to that higher quality borrower,
Yes.
proof of income, higher credit score, debt to income, all the things check. And they know that they can do another one tomorrow if they have a good marketing and originations business, because they can sort of offload that paper to the Fannie Freddies.
That's right.
And
And
it's
so
a cycle.
it's a balance sheet light model, right? You
Yeah.
collect fees, you keep the servicing, the securities that then go through the entire fixed income community globally. It could be pensions buying it, it could be sovereigns
Right.
buying it,
Safer.
and so, but what they did importantly is then they said, look, guys, if you're not qualified, I'm not going to make a claim whether you're a bad borrower or a good borrower. You're just a non-qualified borrower.
Right.
So they
Non-QM.
tell the banks, if you want to originate that, it's your risk now. You have to underwrite it. You have to keep all the paperwork.
And you've got to reserve more capital.
You got to reserve more capital. It's called risk retention, right?
Yep.
And they say the same thing to the private investors like ourselves, right? So basically, effectively, what that created. So, for example, when I left Washington Mutual, I had a W-2 income. So when we started Angel Oak, I go from W-2 income to no income, right? I'm a non-qualified borrower. I may have savings, I may have bank statements, but I'm a non-qualified borrower. So I have to be fully underwritten. And somebody giving me that loan, pools of these loans, they have to keep the risk retention, or they have to have incremental capital towards it. That was the basic.
And that creates more just friction, right, for that lender. So they have to then make a decision. Do we really want to go and, provide the loan to Sreeni? He seems like he's going to pay us back. He's got a degree, he's got good job history, but he doesn't have that W-2 anymore. I mean, it's amazing, but that's kind of how decisions kind of get made, right? So let's talk non-QM and this whole RMBS space, because it's a massive market, trillions of dollars, right? People want to own a home. Not everybody, but a lot of people want to own a home. So it's a massive market. And at the same time, the banks got really hammered coming out of 08.
Yeah.
So they got to start making some board level decisions. Do we want to be in this space or not? You all create a fund.
Yeah.
A mutual fund, a 40 Act mutual fund. You're distributing it. What are you putting in the fund at that time?
Yeah. And so in that fund, we were not putting non-QM loans in the fund because it was an illiquid sector that went to our hedge funds. In our 40 Act fund, we really were introducing structured credit, mortgage credit, still legacy mortgages to retail investors, saying that, hey, if you have $100 in fixed income, I'm not your core bond manager, right? That's
right.
If you want a little alpha on your money relative to other risk assets, high yield corporates or bank loans, you should take a look at what we do, because this is other form of spread and risk. Right?
Yeah. And tight spreads, less return, wider spreads. You've got experienced PMs and experienced risk managers. They're going to be able to pick and choose and know where to get exposure and where not to, because spreads have gapped out and they're wider. So it pays, again, advisors to do the work to find the teams that have the experience, having been in those trenches, having originated that paper. So
it was really what when you go to our website and you see it, for the first 2 years, it was really the education of what was this, right? This was the first time, and to be fair, this asset class imploded, right? So it was right to be skeptical. If you go to the offices today across the country, I travel now, there's a lot more education that has happened about these types of assets. Okay, clearly they may still decide not to buy them for different reasons, but the concept that, hey, don't even walk in here because I'm never going to look at this stuff, that doesn't exist. There's a lot more education in the retail community, in advisors, but in 2011, 12, 13, I would say we were at the beginning stages of this. There were some groups that absolutely had a bigger risk tolerance, but also had more educational level just because of maybe the background they came with.
Yeah.
So, our first 3 years was just literally educating people on what these assets are.
What is it?
Yeah.
But the idea of starting a mortgage company and my numbers might be low. I mean, because I know I've heard over the years, like the mortgage company's growing, you're moving, it's more people. 800 people today in the mortgage business. And why start the mortgage business?
That's right. So when we learned, getting back to like when we learned in 2012 that banks did not want to do non-qualified mortgages. If you think about it, they were still settling the previous issues that they had.
Yeah.
They didn't want to start, right? So they basically just exited the sector. So created a vacuum. And so who starts it? It would either be private equity firms, the big private equity firms, or guys like us. So we stepped into this because of one important thing. I had a partner that knew how to start a mortgage company. We as asset managers, I would have no idea how to go in and start a mortgage company.
Right.
Why did we need to start a mortgage company? Because nobody was originating these loans. So where do I buy them from? But the other thing we did is we said this time around, we want to originate to own. So our whole belief was that we want to introduce this asset class to institutional investors.
Mm-hmm.
This time around, we want to be what we call private credit managers of mortgage credit. So how do we start that? So we said we want to own. If you want to own credit, we have to prove that we are underwriting it from the time the loan comes in. And how do you do that? You start a mortgage company. So we started a mortgage company. We were doing 10 million a month, probably not even making money. But it was how do you say chicken and egg kind of story.
Yeah, you got to make that call.
Yeah, if I go to institutional investors and say I want to raise $100 million, and they're like, "What asset class are you starting?" And if I told them I'm doing 10 million a month of origination, and nobody knows about this sector, nobody's going to give you money. So you have to prove to raise institutional money that A, this asset class was legitimate, B, the securitization existed, and C, the size of the market would grow. Those are the three things we were working on. So by 2015, we had originated about 200 million of these mortgages.
Mm-hmm.
And I believe we were doing it in a hedge fund. But we knew that was, that could only be a small part of the hedge fund. Obviously, we couldn't just put every single mortgage in there. And we did the first, I think we were one of the first guys to do a securitization in December, I believe, of 2015.
Yeah, it was a private. Was it a private securitization? Like you got it rated?
You would not get the rating agencies to give us.
You didn't do any rating, no private rating. Okay, so you did a securitization, and you put a bunch of the mortgages in there. And did you take it to the insurance market? I know they like this stuff now, but at the time, were they buying?
It was insurance companies, asset managers, some hedge funds, right? Okay. Guys who knew about this asset class.
Yeah.
Large money managers that knew what we were bringing to the table. They came to our offices. They looked at our underwriting standards. So there was a full-blown due diligence. The world has changed dramatically than just buying bonds now.
But did you get a total different reception? The fact that you could say, we underwrote it. We originated, we underwrote it. We know exactly what's going on. We're servicing it. I mean, that's different than saying, oh, we bought it here. And, it's like, well, I don't know. I mean, what was the reception?
Well, reception, but also, just again, things happened in your life. They didn't have to. These guys who bought our senior bonds, they didn't have to sponsor our securitization. They could have said, look, let me buy the next bond. It's unrated. Why would I take a risk as a portfolio manager? But they came to us, they supported our program. They also wanted to grow the next non-QM 2.0, which is what I call it.
Yeah.
And they bought the bonds, so, it's satisfying to start small.
That's amazing. That's amazing.
And a proof of concept. And then we could go to the institutional community and say, now I need to raise the dollars and I'm going to give you risk retention. Yeah. We manage your credit. We're managing your credit. We're not just, we're not a capital markets exercise. We're managing credit for you. Number one.
Yep.
Number two, we are creating an efficient financing for those bonds. That was the basic thesis, right? It was not, hey, we originate loans, we finance, and you get your levered return. No. We underwrite credit. Now, we can underwrite credit and you leave it unlevered for you. But if you want leverage, the best way to do it is through securitization, locked-in financing.
Yeah.
And that really grew our private credit business, which is about $3 billion today, all institutional money. But we had two companies, retail and wholesale.
Yep.
At the peak, we had 800 people. We sold our retail business.
Okay.
Around 2021. That was not core to what we did, but it was a great business to have had. So today we have, I think, close to 250 plus people. and all we do is non-qualified mortgages, prime jumbo mortgages, and we now start up HELOCs.
So yes, and we're going to talk about HELOCs. This is, man, we're getting out on the curve here. So to simplify it in terms of the chain of how this works, if I'm a gig worker,
Yeah,
and I've had 5, 6, 7 years of consistent income, but it's non-traditional income. It's not maybe W-2.
right.
It's gig income. Maybe my spouse works, freelances. Maybe not. Maybe I'm solo, and I want to go get my first real estate property. Maybe it's an investment property. Maybe it's an owner-occupied property. But who's that individual calling? How do they find their way to the funding that you guys provide to, I would assume now that's that retail customer-facing originator? Explain that value chain and how it works and where your capital and your investor's capital comes into play for that gig worker.
Yeah. So that gig worker, it could be also be a dentist that starts. It could be exactly what you're doing right now.
Yeah.
And basically you're working for yourself, real estate agents, real estate brokers.
Yeah.
And our first clients were probably real estate agents because they understood what we were trying to prove. And if you, when we started, it was a good timing because if you're a real estate, so that individual is going to a real estate broker in town or a bank, right? He's going to a bank and he's saying, "Can you give me this mortgage?" And that guy who's sitting at a table, he's probably doing let's say 5 to 6 government mortgages or agency mortgages a month. He doesn't have time to understand the non-qualified. He knows he's not going to originate the loan. The bank's just not going to do it.
Nope.
So he goes and says, "I want to keep the relationship with this guy." So he calls Angel Oak and says, "Angel Oak, the most important thing for me is to keep my relationship with the guy. So if you don't want to do the loan, don't do the loan, but don't drag him for a few months and then call, I can't do this loan."
Right.
So what we told those brokers or real estate agents or bank brokers, "Hey, Angel Oak is here to originate this loan and buy the loan, and we have fund capital. So it's not like every loan we make, then we are looking to find out where we could sell this loan to." That's
right. No. Yeah.
And the other thing we did is we said we took all the work out of that broker's hand. We said we'll do it. We'll do everything.
We'll underwrite
it. We want to do it. We want to underwrite. Because also that gave us data and analytics, right? So every time we're doing a loan, we're getting better and better and better. What is a good loan? What's a bad loan? What documents do we need? What documents do we not need, right? Originally, we were asking for a lot of documents, right? Because we didn't know which ones were really needed. And we got more efficient. We started using more technology. But in the beginning, that was it was like you said, it's customer, it's education of the customer. Then the biggest thing we have to explain to them is, if the mortgage rates are 5%, why am I getting 8%? So now we have that to go to. But customer service was where our mortgage company shined, and even today shines. Yeah. Right. So we still have guys that we have. There's a lot more competitors. It's a competitive market. It's a little bit more commoditized market today than it was when we started. But people come for service, right? There are places where people go for price. There are places people come for service. We are the service on that.
And when you that's huge. And I've been in private credit, when you develop a reputation for saying, we're going to take a hard look and we're going to give you a quick no, or we're going to actually get constructive on the underwriting, that's the best thing that you could possibly hear if you're a broker or trying to arrange finances. Just give me some certainty. Don't drag me along. Don't drag me out, because they're trying to get that capital, execute their deal, close on the real estate transaction. And if you get hung at the altar, there's different terms for this in the industry. It's just a non-starter. You're never calling that lender again. So the service, the reputation, delivering, saying this is our credit box, all that, it's huge. Yeah. You all are, there's a lot of things we could cover, but there's some areas that you're now evolving into today at Angel Oak. You've got this obvious, deep reservoir of data, deep reservoir of experience, a much bigger team of experts now. Fast forward, you're running $20 billion. You've got an ETF business. it just surpassed $1 billion.
Yeah.
Did the experience? I want to ask: did the experience you learned on starting the mutual fund and hey, retail investors want this exposure. They want this underlying collateral in these assets, but they don't want it in a private fund. We need to go start a mortgage company. What was the thinking of starting the ETF business? I'm curious.
Yeah. So, no, as we evolved as a firm, a few things we learned is that the retail community, if you think about it from our business, everybody, when they launch funds, they think that, oh, you have to raise institutional money because that's more sophisticated money. That is not true. I've learned that along the way.
Right.
First of all, the retail investor base and the depth of, in terms of the overall market, is a huge market in the US.
Yeah.
It's more sophisticated than people think. It's an insult to call them not sophisticated.
Yeah. Right.
They want to learn more, but they also need to be in what we call solutions. Right. We have to provide them with solutions. And used to be that a lot of I'm not saying it hopefully in a bad way, but you pushed what you thought was good for them, and now they're pushing back and saying, no. I know what I want, and you have to offer me a solution. So if you come with a product every time, I'm going to take your meeting a couple of times, but if you go give me solutions, give me a group of solutions, I'll do business with you at some point when it makes sense.
That's absolutely right.
And then we've been in the business long enough where when we go into we go across the country to individual reps, whether they're at Morgan Stanley or whether they're UBS or whether they're in an independent RIA.
They're RIAs like myself, right? Like, we clear and custody through Schwab, but we, that independent advisory community, we think in terms of just like the guy that's sitting or gal sitting over there at private bank or at Wells Fargo or Morgan Stanley. We're thinking, how do I best serve the client?
Exactly.
How do I bring a solution? And you can't, the days of selling a product, those are short-lived. And as alts have proliferated, just calling up the client, say, oh, we can get 8% here. Like, that's done.
Yeah. It works. It works for a short period of time.
It works for a trade or two.
It works, but that does not create a relationship. So the ETF business is interesting. You'll see it. We had the risks you take in the business, and they were not risks. It was we wanted to do it anyway. We had a individual by the name of Ward Bors. He worked at Invesco, a very sophisticated shop, and he wanted to build out an ETF business. I had no idea about the ETF business, but he walked me through the transition of what's happening in fixed income space and how advisors are using ETFs relative to mutual funds for the ease of and for a variety of different reasons. And so we started seeing that. So again, the feedback mechanism, advisors came to us and said, look, we love your products. Number one, I want you guys to give us more solutions. Again, not one fund, solutions. Let me decide. Give me different shades of risk and return. And B, you got to have it in both wrappers, a mutual fund wrapper and an ETF wrapper. And we took it to our friends on the wirehouse platforms, and they appreciated it. And like I said, if you want a total return bond fund, you know where to go. Right? We're not here. But if you want what we call a core plus plus, our satellite funds, we'll provide you solutions. They will be based on asset-backed securities, mortgage-backed or a variety. And you decide how it affects you. And there will be times when high yield is wider than us, as times when high grade is cheaper than us. You can make your decision. So that's what led us to launch ETFs. I would tell you though, transition, just structurally, mutual funds will shrink as a business. Happened in equities, now it's happened to fixed income.
Yeah, right? Definitely. Yeah.
And ETFs are going to be so. For a long longevity of the business, you have to offer it, right? You could have said, why ETF? It's too much cost structure. It's a lot of learning to be done. But we were excited to do it. We had Ward who knew a lot about it, and he's put a team together. It's been a fascinating journey. But our core thesis is still the same. We are managing credit for individuals.
That's right.
Right. That's the basic theme.
Yeah, I love it. I mean, and so many managers I've had the opportunity to interact with over the years. I mean, doing this now 15 years, the single biggest challenge some of the managers seem to have is they have a short-term orientation on results. Yeah. There's a sense of If I go and hire somebody and don't get an immediate return on investment, that's a salary I just am not willing to continue to carry. So there's high turnover, misaligned expectations, and not a long-term orientation. I know that a lot of times the PM and the founders, and this is to the fund managers listening, it's your capital.
Yeah.
You're putting your money on the line, but you've articulated over 45, 50 minutes, multiple times over the course of Angel Oak's history, where you said, we got to build a team.
Yeah.
We got to make an investment in a mutual fund business. We got to make an investment in growing that team. We got to make an investment in an ETF business. We got to bring in an outside expert. We got to give that person time. I get on my soapbox about this because so many people think that this is just about having a couple stock jockeys and a couple smart people, you know, that came out of really target schools and like big funds. And it's like, trust them. They're good. They're going to be good. Those are not really more, I don't call them real asset managers. They're more lifestyle kind of family offices.
Yeah. No,
And so I really applaud you, because to have a firm that's grown and innovated and changed with the times, recognize the importance of the advisor and the relationship and the investment in education to support the advisor. Those dollars trickle in. A ticket to an ETF might be $1 million, $2 million, $3 million ticket. But over time, if that business grows, that could be a $30 million relationship, could be a $50 million relationship.
That's what you just said is where, you know, people miss out.
Yeah.
Retail business is not $100 million ticket day one, right?
No.
So you have to go get your first 1 million to get your next 2 million, and it takes time. But then the compounding takes over, right?
Yeah.
And a lot of people will say, well, why am I launching a fund with $10 million? What if it stays at $10 million? Well, that's the risk you have to take.
Yeah.
Right.
Yeah.
Generally, you know, if you do the right thing, and patience, you got to be very, very patient. And no, we have, wholesalers is what we call them, who meet all the advisors. You know, I give them a lot of credit, because the PMs is great. Like, money comes in, you manage money. Somebody's got to go get the money and articulate to somebody that we are a small $10 million fund, but you should trust us. And what you find along the way is all the relationships you've built in the past. People trust you and say, I know you guys. I like this fund structure. It's not big enough for me to put all my money in, but I'm going to help put a little bit of money in. And then you put 15 of these guys together, and now you launch something. So again, that feedback from the advisor, and you know what I've learned along the way. I was on the road trip a couple of weeks ago. I'd been on the road for some time. Is we get feedback from the advisors too. It's not a one-way.
Oh, yeah.
Advisors have a lot of information that can be valuable to somebody like me, because they're managing a lot more money than we are, right? So,
yeah,
you know, what's going on in the market? You know, what are you doing for your clients? Where can we be value at? Not just short term, but long term, and that's important. So you know, that's why it just doesn't start with, hey, here's $100 million ticket. That's not how it works.
It doesn't work that way. I want to pick up on a piece that's on your website. Again, to all the listeners, I would encourage you to go out to angeloakcapital.com. There's really great resources, content. You can get to know Sreeni and Mike, the co-CEOs, through some great content they've put out, but also just the department, the research, the data, all those things. There's great articles. And one of the ones that I wanted to ask you about is, you say in today's markets, this is from one of the articles. This is, I think, from a few weeks ago, so it's very current. In today's markets, however, value potential is historic due to mortgages trading at steep discounts. There's a great chart about spreads, and the chart talks about corporate spreads. So these would be bonds, AA, AAA rated bonds. They're trading pretty tight. The opportunity to add mortgage-backed securities at some of the most compelling spreads and yields. Again, corporate credit, tight spreads, less relative value there. If you're an advisor thinking about, where do I get income for my clients, my retired clients, my clients that are, you know, trying to spend the next 15 years not grinding away, but they want to generate income, but also just be people that have that exposure and want that income. And then an opportunity in agency but your all's expertise is the non-agency RMBS, which are trading, as you say, at wider spreads than historical averages. I said a lot. There's a lot of terminology there. Explain that in layman's terms, as if you were talking with an advisor. You're not giving financial advice on this show, but just generally the idea of relative value, corporate versus non-agency, and some of the historic opportunities that you guys see at Angel Oak.
Yeah. I mean, so in layman's term, when people buy credit risk in fixed income space, right? So you can buy basically treasuries and you can earn your return. And then if you want to get a little bit more than what treasuries give you, if treasuries are giving you 4, you want to earn 5, then historically people went to corporate bonds, right? That was where people invested. And the first thing you do is you buy high grade corporate bonds. These are companies where the credit rating is BBB or higher. Or you go to high yield, which is companies that were below BBB, so BB single A. And that was, and if you go back in the 80s, nobody in the retail side bought high yield. That was a institutional asset class. Then actually became more liberalized to the retail community, and now retail, it's a part of the asset allocation model, right?
That's right. Yeah.
Yeah. So I think what happens is even today, when you're buying, when advisors are buying for their clients and they want to take on more credit risk, the first place to go is corporate bonds. That's just now, we know that's just how it works. You go to munis, you go to high yield munis, but really that's what sectors are happening. So while that's happening, you have this mortgage sector that nobody thinks about. Is one of the largest markets in the world.
Right.
So the question becomes, why is this sector then cheap? So that's the question I get. Sreeni, I saw this movie in 2008. That was cheap for a reason, because underlying borrowers were defaulting. That's why it's cheap.
Yeah.
But it's not the case today, because then they look at it and there's not many delinquencies. So what's happening?
The data is on your website. I mean, it's a phenomenal story. I mean, we can't talk about it enough. You gotta dig in if you're an advisor, if you're a fiduciary. You gotta dig into this stuff, because when you start looking at the data and the comparison of historical trends and what's defaulting and what's delinquent, I mean, there's a story there, and I wanted you to have the opportunity to tell it.
Yeah, I think the way I tell people is, hopefully this works out, is the difference between buying a corporate bond. You bought a corporate bond that says it is going to refinance in October of 2027. Okay, so it's a 3-year kind of a bond. You bought a 3-year bond. Okay, if rates go up 100 basis points, you lose 3% of the value of the bond.
Yep.
So you know where the up and down is. Then you bought a pool of mortgage bonds, and in 2021, if you bought those bonds in 2021, there are thousands of mortgages underlying.
Yep.
People are refinancing 20-25% a year, right? People move, people change their job. So if you have 20-25% of people refinancing annually, what is the duration of that bond, right? Let's just say simple math is 4 years, 20-25%. But then you go to 2022, and the Fed has now increased rates to 5.25%, and pretty much nobody's refinancing. Now, what's the duration of that bond? So that's what creates an opportunity to invest, because the spreads had to widen out to reflect the fact that the duration of that bond, just like a corporate bond, the maturity is what it is.
Yep.
In mortgages, they extend on you. The maturity gets wider. Now, the reason we say it's the best, one of the better times to buy, is now you're buying those borrowers, underlying borrowers, assuming that majority will never refinance, and you're buying them at discounts. So if they don't refinance, you collect your coupon, you're in a beautiful place, not many delinquencies, and you collect your coupon. If rates go lower over the next 2 years, and even if 10% of those borrowers refinance, right? When they refinance, they give you 100 cents back. Let's say you bought the underlying loans at 80 cents on a dollar, you get your total return. So what we tell people is, this is the unique time where the total return, which is the opportunity with income, plus the price appreciation, we believe is the best in non-agency mortgages relative to corporates, right? It doesn't mean corporates is bad credit. The combination of achieving a total return is a greater opportunity today in mortgages, agency and non-agency, versus corporate. That's what we tell people.
And that's a relative value trade, ladies and gentlemen. That's it. The relative value hedge fund forget all that. You just got a masterclass. Sreeni explained it. One other theme I want to pick up on and talk about before we wrap up, and I appreciate all the time today, Sreeni. Second lien mortgage market. So I'm going to just use myself as an example. My wife and I, 3 kids, we live out, suburb of Smyrna. Our mortgage when we got our house, 2016, I don't know, it was 4.5-ish, 4.75%. I think COVID hits. There was an opportunity right before COVID, maybe. We locked in at sub 3%.
Yeah.
Refinance. The idea of picking up and moving right now and shopping for a mortgage, much less shopping for a house for our growing family, it's just a non-starter. We just don't even think about it. There are days when my wife would like to throw me out, but but there's millions of people out there. We're blessed. We're very fortunate. I know that. And credit to my wife. I mean, she holds it down. But there's millions of Americans that are in that same boat. They're not going to go refinance for various reasons. And yet people always need capital.
Yeah.
There's always a mortgage, or there's always an addition you want to make. There's always a wedding you got to pay for. There's always college tuition. So the second lien mortgage, the second lien market, explain that opportunity. I don't know if my setup helps in terms of the story, but this is a market that I think people need to understand and invest potentially around. But to invest around it, if you're an advisor, you got to understand the setup.
Yeah. We it's funny, we talked to a group of advisors. They were friends, and we talked to them in my trip to California, and they immediately got it because 2 of them, their wives were in real estate agents, and they obviously were in sub 3% mortgages, and they got what this is about. So, historically, people use second liens, or they call it HELOCs, home equity line of credit, to get more equity out of their housing, right?
Yeah.
And in the financial crisis, that was used to just lever up more and more and more. So it was really not the best product, and probably added to the financial crisis.
Right.
So people look at it with pain today that the only guys taking out these are the guys that are desperate for money, and that is not true in that.
No.
What has happened after the financial crisis, if you think about it, mortgage credit delevered, right? So a lot of these borrowers are sitting on not only lower interest payments, but 2016, I can do the math. Your property is appreciated pretty decently.
Oh, yeah.
Very nicely. And so you're sitting on 50% loan to value, 60% loan to value. Now,
right.
I'm guessing you're operating from your house and took down a part of your house, and your wife loves you. You're on a mortgage, but she may say, you know what, you need to get out of that room because I need that room for myself, and go make it into the house.
Yeah.
We talked to you about that.
Yeah. Oh, yeah.
So you're doing so, or you may need a pool, or you may put an addition to a garage, or pay for kids' school. So you're using the equity, whether it's just like whether you want to sell a piece of your stock portfolio, for example, right? It's the same.
That's right.
Same thing. So what we think is an addressable market, right? I think the equity all in U.S. housing is somewhere north of 20 trillion. Sorry.
Trillion. Yeah. 20 trillion.
Equity. But what we call tappable equity, this is not like people going to 100% loan to value. What we call tappable equity, which is taking a person from 50 to 70, 60 to 80, 40 to 60, is probably $2+ trillion asset class right now.
Annually?
And overall, right? I mean,
annually,
overall.
Got it. So let's call it $2 to $3 trillion.
And not all of that is going to be tapped, but that's the tappable market.
But that's a big market.
Yeah, this is hundreds of billions of eventual annual issuance.
Oh, yeah.
And that market is just beginning. There's few players in that. Again, private investors. And we feel we're already doing it. We're already originating and purchasing it in our funds. We look to launch new funds around that in a private side. But again, this is good, healthy borrowers. You're still doing underwriting on these borrowers. And because we have data we're not lending to the same borrowers we gave a first mortgage to, but we have the data on what this looks like. We have data on home prices because we're originating in almost every state every day. So the data helps you in this environment. So in an interesting way, also, this may have allowed the Fed to keep the brakes on for a longer period of time, because if you go in any weakness, you have all the housing. Well, what caused the financial crisis was the housing.
Yeah.
What is the safety this time is the housing. You know,
That's
how
right. That's
um,
right.
so we think this is a tremendously addressable market. People are going to use it to do additions on their house. People are
That's
going
right.
to use it to balance payments. People are going to, it's a relative value in the household, right? What do I do? Should I dip into my 401k? Do I sell my stock portfolio? Do I borrow on my house? And those are the decisions that are being done on a daily basis.
And that's a great segue. You know, going back to talking about the advisors, the big focus here about education, awareness, bringing them expertise and guidance. You know, we're not selling anything here. I think, you know, there's a real opportunity for the advisor community to step back and look and say, how do I help bring solutions to my clients?
Yeah.
And you just described one. You
Yeah.
know, if I have a $50,000 expense coming up, you know, or you know, my kid's 7th grade, 4th grade, 2nd grade, you know, college one day, hopefully, if we're blessed. Those expenses, you know, are out there, and we know the cost of college. We know the
Yeah.
cost of healthcare. We know the cost of, you know, parents moving into assisted living. Those things are out there, and yet one of the single biggest, if not the biggest asset most of these advisors' clients probably have is the home.
It's a home.
And the idea of saying taking on debt for some people is like, I wouldn't do that. Why would I do
Yeah.
that? And yet there's an opportunity. And I think it's just about educating and becoming aware as advisors, and then
Yeah.
knowing who are some of the folks out there in the market. If maybe I don't want to go recommend my client borrow, I want to invest in that market because I understand it.
Yeah. I agree.
You know, very compelling. Yeah, very interesting. Yeah. So I want to wrap up with 2 final questions, Sreeni, because I know that we could go on and on, but out of respect, you're running a large organization. You've given examples of innovating and continue to reinvest in the business. You know, Fed Chair Jay Powell announced last week at Jackson Hole, you know, the annual symposium sponsored by the KC Fed, and I have to say that because that's my hometown.
Yeah.
Go Chiefs. It's time. I think his quote was something to the effect of it's time to start thinking about rates, you know, or cutting rates. So more of a macro question, you know, when you hear that and you guys are paying attention to this, it's part of the core DNA of the business is understanding what's going on in the housing market, the mortgage market. What's your posture now when you think about the macro as it relates to Angel Oak, your big team, and kind of growing and building these relationships? What's the setup looking like?
Yeah. So, look, we, in fixed income land, right, we had a honeymoon, and I tell this to my guys all the time. After financial crisis, first 2 years were difficult, but when rates are at zero, anything in fixed income was working, right? Nothing else
Yeah.
not working fixed income. So part of the growth of Angel Oak is also the timing, and you got to be lucky sometimes. So you cannot say everything.
Absolutely.
Our amazing work and smartness. Timing was great, and the Fed allowed a lot of the fixed income community to grow. Right, people could just buy credit because Fed was a backstop. I think 2022 was probably the toughest year for Angel Oak because rates went up. People pulled out of fixed income funds to go into money market funds. Spreads widened out. We probably had our toughest year as a firm, but it also allowed us to grow and build out new solutions. So that's the business side of it. But where we are in the fixed income, what I tell guys is yes, Fed has macro. We are going in a slowdown. None of us knows a soft landing, hard
Right.
landing, or we don't know that. But if you had to ask, most likely we are in a soft landing. Our team actually thinks we are more in a hard landing, but maybe we are fixed income, so we always think hard landing.
Yeah.
What I tell our clients is that expect the worst. So if you're buying an asset today, look at the total return. You're getting paid a lot more to be wrong. So if you go in hard landing and credit spreads widen out, Obviously, Fed is there to lower rates, but your coupon is offsetting your price loss. And that's what people have seen over the last 9 months. So from a risk management, I think we have to manage to a hard landing. That's what we're paid to do. We're not paid to manage to a soft landing. I think the Fed is, we can say they were late or not. I'm not going to debate that, but looks like trending towards the way I say it is, if you keep rates high enough, and look, we're in housing, and housing is in a different place, right? But if you keep rates high enough, you cannot shock corporate borrowers, commercial real estate borrowers, small business borrowers who are borrowing at 0%. They build their businesses based on 0%. And you cannot shock them at 8% and keep it there for 7, 8 years. You just can't do that.
No.
It has to be methodical, right? And you cannot say weak borrowers should default. No, you built the whole cycle around zero interest rate, where people build their businesses, hire people. So you have to give people an opportunity. If you have 100 people, you lay off 20 people. If you have
they got to delever, and they got to manage that. Yeah.
I think the Fed, I believe, these are sophisticated people out there. So I think the Fed understands that. So I think we're going to an environment still of delevering, even if rates are going down, as bid-ask starts. So commercial real estate will start moving around. People will still have to take losses, but maybe not significant losses. And there'll be a movement of this. So we feel we're entering a healthy environment, but selection of credit is going to become important. Yeah. And that's, I think, the main theme that we tell people. Unless the Fed goes back to zero, which I don't believe, and if a high net worth individual or an advisor is making a healthy return on his core bond fund, what is the value proposition? And it has to be relative. So I think fixed income will have a great 5-10 year run at this point across the board. But we have to prove ourselves. We don't have the Fed backstop anymore, and we have to deliver risk-adjusted returns to our clients. I mean, that's just the environment. And I think this is a healthy environment, because we have been in an unhealthy environment where anytime when there was a weakness, Fed would just buy assets. So why would you bought the worst asset because Fed used to backstop? And I think that environment is gone. So I think it's great. When we look at underlying borrowers, we have to look at them, but we have to also look at how we finance on a private side. But on the mutual fund side, it's relative value. I think, and so I think we're going into an environment where I believe there's a slowdown happening. I don't know how fast or furious it will be. We're not talking about 2008 here. That's not what we're entering. But weaknesses can exaggerate very quickly or exasperate very quickly.
Yeah.
So that's what.
Well, that's helpful. That's helpful. And I like I said, I've said it before, but I mean, I've gotten some great updates over the last several years through you guys, the website, the content that you've put out. You've really leaned into that education, which is critical. I mean, education, information, inspiration. That's my tagline here. And so there's always an end to these podcasts where they ask, what are you reading and what do you do in your free time? I'm not going to do that. I don't like to do that. Nothing against that. I like to ask more the question I like to leave with that inspiration. If you were asked to come back, maybe you have been, and talk to the students that are at Georgia State College and University in Milledgeville. You're talking to a finance undergrad class, let's just say, and they're wondering, how do I do that? When you think back on your journey so far, and I'm not dating you and saying, okay, he's going off into the sunset. You seem like there's a lot to do, and I look forward to watching that journey selfishly because you're here in Atlanta, where I'm based. But what would you say to those folks? What are the things maybe you're saying to your younger employees as you grow the business that matter?
Yeah, we have a very, and I love it because as a part of what I wanted to do, because I knew how hard it was to get an internship when I was at Georgia State University. So we do a pretty decent size internship program, and what I tell them is, what I would tell everybody in school is, life is long, and you don't have to peak in your 20s. That's not how it works. And so, sometimes there's this nervousness when you look across and you see maybe some of your peers, growing faster in their career or being, it's all about who you are. A lot of my friends went into IT industry because that was the immediate way of making more money. And to be honest, I stuck with finance because it was easy to go into IT because that's where the money was. That's where visas used to be given to non-US students. And I said, no, I like finance. I wanted to be, I enjoy finance. And so you have to be patient. Two, one of the mistakes I made is, you have to network and talk to professors. It's never the best. The worst thing you can get is a no. And you have to ask. You have to send out hundreds of resumes out there and network because it's hard to get a job unless you come from prestigious. And even they would tell you it's difficult, right? It's not. They also want to compete just like we want to compete. But then just work hard and learn because when you and I were starting, like we used to have one Bloomberg for 20 people in the firm. The amount of data that's available even to college students. I think they have Bloomberg for university students now. That the amount of information you get today, even while you're in college, if the kids can just spend 2 hours in the morning on a weekend, a cup of coffee, and just absorb, the more knowledge you absorb, the better off you're going to be. And then you just grind. And like I said, you don't have to peak in your 20s. With modern medicine, I think we all will live longer anyway. So you might So I said, people, look, careers used to be by 40, you have made your progress, and then you go towards that retirement. That's not how it works anymore.
No, you're at it. That's amazing advice. That's great. I appreciate you. I have one extra credit question. You're a tennis player. The U.S. Open just got underway, not without scandal. Our number one ranked player, scandal about did he use the enhancement drugs or not. I want to ask you more. Are you going to go to the U.S. Open? Have you been? And do you still play the game? Because tennis is huge in Atlanta. And I'm just curious if you get out and still hit the court.
Yeah, so all my boys play. So I play with them. I cannot keep up with them anymore. They're 17, 14, and 13. I think I can manage my 13-year-olds still.
Yeah.
17 and my 14-year-old. I don't play much outside, but I love playing with them. That's a part of what we do as
awesome.
father son. We go hit on the weekends. I'm very regular at US Open. I'm not going this year. Just one of the years when I'm not going. I'm excited. It's going to be a good tournament.
Yeah.
So we'll see.
That's cool. That's great. Well, this has been I thought just a fascinating conversation, like a whole tour and history of Angel Oak. And I really do appreciate the extra time, Sreeni. One, because I wanted you to have the opportunity to tell the story of Angel Oak, but also to offer some insights, advisors that are very practical, timely, and also to managers and even younger professionals that are out there and aspiring to enter the industry or to work with with managers that are growing. 20 billion is certainly big. And I expect in a year or two, it's going to be a much bigger number. So congratulations to you and Mike and the rest of the team over there at Angel Oak.
Thank you, Andres. And really, I appreciate the opportunity you gave me. So thank you.
Well, ladies and gentlemen, Sreeni Prabhu, co-founder, managing partner, co-CEO, Angel Oak Capital Advisors. To learn more, you can go to their website, www.angeloakcapital.com. And with that, we'll sign off. Sreeni, thank you so much for joining me today on ATLalts.
Thank you so much. I appreciate it.
All the best.